Okay, great. Question 6 to 10. So let's look. This is a bit of theory, so it's good to do a bit of revisioning over here. This is talking about ABC. So it says that ABC. So the higher they are, the more likely they are to have an effect on the full cost and therefore the pricing. So ABC is that does make sense. Useful ABCs when there's considerable diversity, yes. So the more complicated these costs are, ABC is much better. So really the reverse of this is that the smaller the overheads are and the more volume driven they are, the less ABC you need, right? So the answer there is this one. Both are fine. So for this one, Fitzgerald and Moon, I talked about this briefly. I'm just going to kind of jump onto a next page. I sort of put some theory together kind of to show you. Really, the reference to this is in your textbook, page 394 and 395. So really what we have here is Fitzgerald and Moon who tell us that just in the same way with balanced scorecard, they focus on financial performance. The argument was for financial performance, you need to think about the three things behind it. Fitzgerald and Moon talk about competitive and financial performance. They call that their downstream, kind of your final results. And they tell us that that's supported by four determinants: quality of service, flexibility, innovation, and resource utilization. So these are the four things that will drive this final result. And you just want to review this and remember it. And these are referred to as determinants. They determine these two qualities. So that taking us back here, that kind of gives us the fact that this is correct. And then it talks about here, it's standard for performance. So you also need targets. So these guys go on to talk about certain targets. You also need to have certain targets in place. And those targets are, just looking at your textbook if you're there, page 394, 395, ownership, equity, and achievability. So those are the targets. You want to make sure those are in place. As well as finally they talk about rewards. This question doesn't talk about rewards, but this question does talk about targets. And those are the targets there: ownership, achievability, and equity. So both 1 and 2 are correct. What you want to watch out for in the exam is sometimes they swap them. So they could put like something from rewards in here. The answer then would be no, of course, because it has to be all of them. So you almost need to remember them. But it's just by looking at them regularly. So there's no need to, don't panic, just sort of look at them from time to time. So the answer there is D. So what's going on here? This is a good revision question here. Return on investment. So what we have here is, again, remember return on investment is literally what is the return on the investment. So the return on the first one, let's just look at what the current return on investment is. 40 divided by 150. Yeah. So mine is rounding up, but I think that the actual return on investment when you do 40 divided by 150 should give you, my calculator is rounding up, should give you 26.7. This is quite important actually, that you allow it to do the full thing. Because what I got was, when I added on, because mine is rounding up, it's not allowing me to really see what the difference is. What you then want to do is, let me get my other calculator real quickly, see if I can solve this problem with rounding. Right. Okay, great. So the first question says that what happens when we accept a new venture? So if we accept a new venture, we're literally adding the 2 onto our current 40 and adding the 10 onto our current total assets. And let's see what the new, so we should have 42,000 divided by 160,000. And let's see 42,000 divided by 160,000. And you will see that you get 26.25%, and that's less than this. So technically, you wouldn't accept it because it's lower than your, if you like, it's lower than your current return on investment. With residual income, literally says, right, well, what's the new profit, and take away this a percentage or this cost of borrowing on the total assets invested. So what we're literally saying is here with this scenario is that, okay, no problem. The new profit, of course, we have currently 40, we're going to take on another 2 minus 10% of what we're currently investing, 150,000 plus 1,000. So 10% of this is 160 is 16,000. So we have 42,000 minus 16,000. So our residual income actually is positive, 42 minus 16. So we take it. It's 26,000. So we take it. So yes, as long as it's positive, it's really marginal revenue. As long as it's positive, we take it. Let's look at the others though. Managers will always accept costing 10, which earn a profit regardless of the. No, that's not true. We've already worked it out. So no, we won't. Based on ROI, we won't. Right? And we'll accept a new possible regardless. Will never. No, that's not true. They will accept. So the answer is B. C and D are kind of dud questions. So great. Let's carry on. Number 9. Yes, target costing. Again, good revision. I want to highlight just a couple of things. Go to your textbook very quickly. Page target costing. Page 43. Page 43 of your textbook. Sorry, page 49. Page 49 of your textbook. Target costing is really about trying to work on. We can't do much about our price, and we have to try and kind of see if we can manage the costs. So just let me first tackle this question. It's a method not well suited for service businesses where most of the costs are fixed. So whenever you have a scenario, well, in this case, they're telling us that when you have costs that you can't do anything about, well, then there's very little you can do, you see, because target costing is all about trying to manage those costs and trying to replace them. But typically service businesses where costs are critical, and you can't. If they're fixed, they're fixed. So unfortunately, it probably won't work very well for you in that scenario. It says here, it's a costing method that ensures new product R&Ds are recovered in the target price. No, this is life cycle costing, straight away. Now, the other thing I want to highlight very quickly is on page 49. There are 5 things that you should remember about target costing. Problems with target costing in the service industry, right? And it's the intangibility, if you like, inseparability. Just because we can't do all these things, it's difficult to separate actual services, individual or mixture of services. So target costing becomes very difficult. Heterogeneity, perishability, and no transfer of ownership. So please look at page 49 and just look over those again. Those are problems we always get with target costing. And quickly, number 10 for this video, the following statements have been made about variances. Favorable variances are always good for an organization. Well, on the one hand, I know you want to say yes because you think, oh, of course, that must be good, of course. But let me ask you a question. What if you you were supposed to use 500 kilograms of a certain material, and then what you decided to do was you decided to buy a cheaper version of a material. Well, so let's say 500 kilograms, and you were supposed to spend £5 on each kilogram. So you go out and go and buy something cheaper, and you pay £3 for it. So straight away, this is a favorable variance. But it's a cheaper material of poor quality. Does that mean it's always good for the organization? No, I think so. I wouldn't argue that. So they almost want you to just think a little about, the reasoning, and they'll help your writing anyway. Variance analysis, if you like, is the comparison of actual reports with original budget. Absolutely not. This is your fixed budget. We're looking at flexing. Variance analysis, good variance analysis is really about flexing a budget and comparing that with the actual. So which of the statements are true? None of them true. None of them true. Great. End of that video. See you in the next.